The rule of 72 is a mathematical formula that estimates how long it takes to double your money at a given growth rate. For example, the S&P 500 has a 100-year track record of returning at least 10% a year. We take 72 divided by 10 and voila, it would take 7.2 years to double your money. The Nasdaq has a 50-year track record with a growth rate of around 14%. So 72 divided by 14, your money would double at around 5 years. Over the past 45 years, Warren Buffett's Berkshire Hathaway has returned 19.5%, almost doubling the S&P 500, meaning investors would double their money every 3.5 years, which is why Warren Buffett is one of the most, if not famous, investors of all time. The compounding effect is found in an asset's growth rate. In financial terms, we call this the compound annual growth rate, which basically calculates the rate of return based on an asset's history. But you want to measure an asset's last 10 years of performance to get a more realistic future return. For example, as of December of 2024, Bitcoin has a compounded annual growth rate of around 214% from the time of its conception, which would mean your money would double every 4 months. If that were true, it would be the ultimate money glitch. So we look at the last 10 years of Bitcoin's price, and you get a compounded annual growth rate of 82%, which means your money would double every 1.2 years over a 10-year period. Maybe it's still a money glitch, but only time will tell, so we continue to watch. But the reality is, some years can be very negative or much lower than what the growth rate predicts. On the other hand, there are years where the S&P returns over 20% and Bitcoin over 1,000%. The growth rate simply smooths out these wild swings into an average expected return over a 10-year period. Now, the S&P 500's 10-year growth rate is about 10%, and that's comprised of 11 sectors. As you can see, each sector has its own annual growth rate. And if we add in gold, housing prices, and US Treasury bonds, you can see the different rates of return. The information technology and consumer discretionary sectors have the highest rates of growth, with Treasury bonds performing the absolute worst over the last 10 years. Now, the rule of 72 is a quick way to calculate the speed of the compounding effect. Different assets have different growth rates. And now you understand the power of compounding, but there's another component. Additional contributions can supercharge this compounding rate, which we will talk about in the next lesson.